All right. What is missing from the arithmetic of active management logic?
Okay, so to catch everyone up who may not be familiar, Bill Sharp, who won the Nobel Prize a very long time ago, had this very famous paper called The Arithmetic of Active Management. And the idea is simple. The alpha of the whole market, let's imagine the whole equity market as a whole, with respect to itself, the alpha zero of the whole market. Now, if passive is just tracking the market, well, then the alpha of passive has to be zero. But if the whole market has a zero alpha and passive is a zero alpha, that means when we add up collectively an evaluated average basis, active has zero alpha. And this is kind of one of the critiques of active management, like, well, on evaluated average basis, active can't beat the market. But there's kind of two important assumptions here, and I hope we get back to the second one. So the first one is that passive actually holds the market, and passive may not hold the market. And the second thing is it assumes a static investment universe. It assumes that the set of investment opportunities is fixed. And this is also not true. And so these two things are where the arithmetic of active management might break down.
Okay, so let's back up for a second. What is the market? Because I think we kind of take that term for granted.
That is a great question, and that kind of exactly gets to what this paper is about. So I think you could imagine a really extreme version of the market, which is at every point in time, you're going to hold on a evaluated average basis every publicly available security. Now, this is actually infeasible, right? Because if you're running an index fund and you, for example, wanted to replicate this, it would mean that when an IPO happens, you need an allocation in the IPO. When an SEO happens, you need an allocation in the SEO. When a buyback happens, you need to be able to sell into the buyback. Of course, so the market could be every ordinary common share traded on major exchanges at every point in time. Now, no index fund can do that, so they say, well, we're going to add new stocks with a delay. So, CRISP funds run Vanguard, they add an IPO 4 days later. S&P, they're going to wait a year for 4 quarters of GAAP earnings. Russell waits between a quarter and a year. So the definition of the market actually depends on what is feasible versus some kind of theoretical ideal.
Hmm. What's the main objective of an index fund?
Right. So that's a great question. So this is, I think the way the index fund game has been played, and correct me if you think I'm wrong, is an index fund's goal is to track a particular index. So Russell comes out and says, this is the Russell 1000. And the Russell 1000 manager says, I'm going to minimize tracking error, defined as the standard deviation of the difference between my fund's returns and the index's returns. I'm going to minimize that. Now, how do they typically do that? Well, you could hold all the stocks in the right proportion. When a stock gets added, you buy it in the close and the day it's added. When a stock gets dropped, you sell it in the close and the day it's dropped, right? And that's how you're going to minimize tracking error. But this, I think, kind of deviates from our original idea of like, the CAPM prescribes that it's optimal. Like these really old theories or like modern portfolio theories, they prescribe for a lot of people or everyone, it's optimal to hold some combination of the risk-free asset and the market portfolio. That's what's optimal in the CAPM world. And so I think the genesis of index funds, if you read the Nobel Prize announcement for when Gene Fama won the Nobel Prize, they argue that this is like when markets are efficient, like this is what is the motivation behind index funds. So the goal is to track the market, but the market's not feasible. So we've made the goal to track a particular index. That's kind of one way to think about it.
So the goal of the main objective of an index fund is to minimize tracking error to an index.
Exactly.
Okay. How well do index funds track the market?
Right. So first of all, I think a different question is how well do index funds track indices?
Hmm.
Index funds really, really well track indices. I mean, this is actually quite impressive. So if you think about VTI, it's a huge fund, over $1 trillion. There's over 3,500 individual stocks in that fund. So VTI has to trade 3,500 stocks. Their tracking error is less than 5 basis points.
Hmm.
That is honestly trading 3,500 stocks to match an index. It is impressive. Now, how well do they track the market? They track the market a little bit less well. And this goes back to something we should talk about. What does it mean to be active and what does it mean to be passive, right?
Hmm.
Every index fund has a different set of rebalancing rules that prescribe what they have to do. So VTI actually is an R sample that we looked at, the index fund that is the closest tracking the market, which makes sense. They hold 3,500 stocks on a evaluated average basis, but they deviate a little bit by about 70 basis points standard deviation a year. Where does that come from? Well, it comes from the fact that they can't participate in these primary market transactions. It comes from the fact that they have certain stocks that they don't invest in. They apply float adjustments, so very closely held stocks. And it comes from the fact that, there's other stuff like even if we think about buybacks, firms might not announce on this day, we bought back this many shares, right? Vanguard might only learn that with a delay. And that's not Vanguard's fault. That's just the way it works. And so I think Vanguard is close, but they still have about, in our calculation, annualized 70 basis points of tracking error.
Hmm.
And then something like Russell, which rebalances once a year. I know they're moving to semi-annually, but Russell, which rebalances once a year, they have a little more tracking error with respect to this ideal market. So yes, they kind of track the market, but they all kind of have different rules that make them deviate in certain ways.
Hmm.
Marco, I wonder if you think we've become a bit too complacent in thinking that well-known indexes are the market, right? I mean, in the media all the time we hear about the S&P 500 or more egregiously the Dow Jones, which is a very crude proxy for the market. And I'm wondering if you feel that the fewer rules that a cap-weighted index has. So instead of the S&P 500 that tracks, 500, not even the largest 500, but there's some selection involved, versus say a total market fund that like VTI, which just tries to hold everything that is reasonably possible. Are those total market index sort of less susceptible to the problems that your paper identifies?
So I think okay, there's a few things. So one, the paper, like we haven't even talked about the problems that I've identified yet.
Right.
But I do think the Dow is a great example. I love it when someone calls me and says, Marco, the Dow is down, 400 points. And I ask myself, what is a point on the Dow? And so
Yeah.
I do think that yes, I think everyone thinks this is the market. And by the way, to go back to the Cap M really should be using the aggregate wealth portfolio, right? And the public equity market is not the whole wealth portfolio. And to give you a particular example, right? Suppose private equity, this is not a critique of private equity. This is what private equity does. Suppose private equity identifies that Ben's company is cheap and they buy it out, right? Now the index funds don't get to hold that company anymore. And the private equity companies benefit from having it cheap. Suppose 5 years later, the private equity company re-IPOs it after having increased the multiple. Now index funds are going to buy it at a higher valuation. So I just want to say that, I do think the prescription of the CAPM is to hold the market. The public equity market is one thing. And then, of course, the narrower we make the index, even less representative it is. But even just to highlight, the public equity market, even VTI, is not what the prescription of the CAPM or modern portfolio theory says is the market.
Hmm. Yeah, that's a good point. It's okay to critique private equity, though, if you want to.
I guess, this is funny. I know, I like stories. And the last time I was down here, I tell a story. I remember my first day in graduate school, they sat us down in this big room and they had the dean come in. And we feel like we were I was like a kid, I didn't know anything. And the dean comes in there and the dean is like, you will one day have great authority on one tiny thing, and you should not use your authority to opine on things you know nothing about. And so, I am not an expert on private equity. I have never written a paper on private equity. And so that's why I'm saying I want to focus on index funds. That's what I've spent, the past, 4 years studying, not private equity.
Makes sense. We did ask Gene Fama about that when he was on this podcast, and he said, we asked him this question, should private equity be included in the market portfolio? And he said something like it's not obvious. We don't have very good data, one, and it's not obvious that after fees that you're actually getting the benefit that the CAPM would suggest that you should be getting. Anyway,
That's a good point. And we'll come back to fees in a second. But yeah, everything we're talking about so far, if you want to talk about what Sharpe's arithmetic is missing, everything I said so far is gross of fees. And if the
Right.
value weighted average active alpha is zero gross of fees, net of fee, it has to be negative. Fama has a famous paper, 2010, in the Journal of Finance, exactly about that.
Yep. Okay, so let's start to get into the mechanics of what your paper looks at. What specifically do index funds do in order to track indexes?
Right. So exactly. So there's kind of two broad reasons that index funds need to trade. One of them we're going to call scaling trades, and one of them we're going to call rebalancing trades. Okay. So scaling trades are like you get an inflow or you get an outflow, or you get a dividend, or you have to pay a dividend, or we have some company that delisted and we get some delisting proceeds. These are kind of all, we can call them cash events. This is when the index fund suddenly has extra cash. I know I'm abstracting from ETF arbitrage, but let's pretend for now it's an index mutual fund. Well, what do they do when they get the cash? They scale all the positions up proportionally. What do they do when they get an outflow? They scale down all the positions proportionally. This also applies when there is imbalance between additions and deletions. So when Tesla was added to the S&P 500, its weight was a lot bigger than the weight of Impartment Investment Management, which was dropped. So if you look at the data, SPY had to scale down every single position by like 1.6% to make room for Tesla. But these things do not change the composition of the portfolio. All they do is make it bigger or smaller. And it shouldn't affect the returns kind of because they're not really changing the composition. The important thing that index funds do is they trade in response to composition of the market. And let's use VTI as an example, and then we can also talk about SPY in a second. So VTI is going to buy almost every IPO. Anything above the small cap threshold within 4 days, they're going to buy. When a private equity company buys out a company, they're going to have to tender those shares and get the cash. When a company, here's another thing though that a lot of people are less aware of. When a company issues equity, whether it's through compensation, secondary equity offering, exercise of warrants, convertible debt, that increases index eligible shares. Index funds have to hold a constant percentage of the index eligible shares of every member. So they're going to have to buy companies that issue equity. Similarly, when a company buys back equity, that's going to reduce their index eligible shares. So what are index funds going to have to do? They're going to have to sell those companies. And so we can imagine if we start with some initial portfolio of our index fund and we have some kind of end portfolio, we can get there with 3 pieces. There's one piece that scales the portfolio up and down in response to flows. There's one piece that deals with additions and deletions. And there's one piece that rebalances among stocks that did relatively more issuance or relatively more buybacks. And that's how we can think about basically every quarter or every year, depending on the index, how they get there. Now you say, Marco, what does this apply to the S&P 500? Well, you could just, the way that I think about it, and this is maybe a little too index fund nerdy, is the S&P 500 applies a float adjustment. They set the index eligible shares of every non-member to 0. And then when they add a stock, that now has a positive, investable weight factor. And when they drop a stock, it goes to 0. And the same exact logic applies to every value weighted index fund.
Okay. So the scaling up and down portfolio sounds less interesting. If
Yes.
you look at those, if we look at the other 2 trading portfolios, what do those look like in terms of something like factor exposure?
Right. So the first thing is like we have to go back, and this goes back to like the literature on this, like what type of companies are issuing equity? Well, companies that issue equity are companies that have usually, relatively high valuation, right? There's an old literature that firms like to time the market. So these are going to be companies that are not very profitable. If you look at a profitability factor, they're going to load really negative like on that. And if you look at a value factor, they're going to load negatively on that. They're going to look more like growth firms. Similarly, when we look at stocks that are added to portfolios, like at the S&P 500, they're going to load positively on momentum, right? These are stocks that have gone up a lot recently. They're going to load positively on like aggressive investment. These are kind of momentum-y stocks. And so I think what you're previewing is we actually did this decomposition for every single index fund in the CRISP mutual fund database. And we looked at the returns to the scaling portfolio, the average return and the factor alpha are just 0. Like you said, the scaling portfolio is not super interesting. What is maybe a little more interesting is the unconditional return of that intensive margin rebalancing portfolio that buys companies that issued equity and sells companies that bought back equity, has a big negative return, and there's still an annualized alpha of about minus 3% per year of that rebalancing portfolio. There's also a negative alpha, although not significant for the extensive margin, like the buying and adding and dropping. That also has a negative alpha, but that's not super significant. And then the last question is like, well, how does this matter, right? We've showed you that the trades that index funds make don't look good. And this is, by the way, like not new. Like the issuance anomaly, like Sheridan Titman 20 years ago wrote a lot of papers on the issuance anomaly. But what we think is interesting, John and I, in our work is we've quantified a way that the issuance anomaly affects the way index funds, given the way index funds work, it affects their returns. And we think it could be 20 to 80 basis points a year, right? If the intensive margin rebalancing portfolio is about 8%, and you get the alpha estimate, you're going to get 20 to 80 basis points a year. And this is a lot larger than fees, right? If Vanguard's charging 3 basis points a year, 5 basis points a year, and you're missing 20 to 80 basis points a year by trading in a way against informed people. Firms know what their stock is worth. Firms are going to try to take advantage and do market timing. You're taking the exact other side of that with these mechanical rules.
Man, so there's you've got factor loadings that indicate lower expected returns for these types of stocks, but then in the case of one of the portfolios, you also have a pretty significant alpha after adjusting for factor exposures.
Yes,
Negative alpha.
Exactly.
Yeah, that's those are ugly portfolios. I don't want to invest in those.
Yeah, so I do want to add one more piece of this is we've tried a lot of different things with those specifications. And this goes back to our original discussion of what is the market. And we can have two kind of broad ideas of tracking error. One is index tracking error, how well do you replicate your index? One is market tracking error, how much do you look like the market? Now, suppose we have a stock that's going to be added to Ben's index, right? And it goes up 100% ahead of time. There's a bunch of really smart, Dan has a fund that goes out and predicts what stocks Ben's going to add to his index. They go out and buy those ahead of time. They push the price up. Now, Ben goes out and he buys in the closing auction those stocks. His tracking error is 0 with respect to his own index because he added the stocks at the price that they're added to the index. However, remember what we said, like Sharpe's arithmetic assumes a static investment universe. Someone earned that 100% run up ahead of time, preparing those shares. And I think what John and I are saying, if you had market tracking error, which includes all the stocks at all points in time, that would include the returns you missed when everyone front ran your index. And that is not accounted for in current kind of index calculations.
Now, is that something your paper is looking at, or is that a separate effect?
So we do have this idea of market tracking error, and this is not in the version that's online yet. That's coming. John and I are working on it. There's kind of 2 points you could say here. Is one, and this goes back to our original debate. What does it mean to be active, and what does it mean to be passive, right? Of course, if you know that there's an issuance anomaly, you can deviate from what you think trading every second and have a different set of index rules. But when you do that, you start to look less and less like the market. So John and I's prescription is that, well, if a firm, sells equity when price is high, why don't you wait to rebalance? Wait 6 months, wait a year, wait for the market to correct the mispricing that the firm is exploiting, and then rebalance. When you wait a year, you're taking more market tracking error, right? You're not holding a stock, or you're not holding the composition of the market as it is. But you also may be increasing your returns by not getting adversely selected by firms. And so in the new version of the paper, we're going to have this idea of a market information ratio, which is going to trade off the additional return you get from, say, buying, at a certain time with how much you deviate from the market. And the market information ratio will account for front running and trading costs. And we have a whole, model of trying to estimate expected price impact. Like, it should all go in there, but we're pushing for a different way to evaluate index funds. If index funds get really front run, given the rules they follow, that is forgiven in standard tracking error in the way it's calculated now, which we think maybe we kind of want to push against.
So Marco, can you give us an idea of how often index funds typically trade? I mean, obviously the answer is going to be different for different funds, but it does seem to me that traditional index funds trade very, very infrequently. If you look up their trading expense ratios, they're frequently rounded to 0. And so if there are these kind of frictional rebalancing costs, how can they be showing up to the extent of 20 to 80 basis points when there are really so few trades?
Well, so first of all, I want to push back on the idea that there are so few trades. So when we calculated, so first of all, an important thing is at the end of the quarter, when a fund like VTI rebalances, right, it actually has to trade all 3,500 stocks. Why? Because even if you didn't issue any equity or buy back any equity, everyone else did something, and that money needs to be funded from somewhere, right? So even if you did nothing and Ben's company bought back a little bit, I'm going to have to now reinvest in you a little bit with the money I get from selling some of Ben's stock. So we found that on average, over the last 20 years, evaluated index fund on a gross basis, this is not the SEC's definition of turnover, which is kind of like a net. On a gross basis, it's like 8 to 10% a year of a portfolio like VTI is turning over. And so that's the first part, is that actually index funds trade a lot. That doesn't account for when they buy a big IPO, they have to scale everything down to fund the big IPO. That doesn't account for, ad hoc events by S&P where they have like a merger and they need to add a new stock to stay at 500. And so I actually think that they trade more than we think. The second thing is, and this is related to my paper with Alex Chinko that I talked about last time I was here, is that if you trade in the closing auction, it's kind of weird. Like our traditional measures of trading costs and like price impact and effective spread or bid-ask spread or realized spread, these things don't really apply in the closing auction, right? There's a price, you submit your market on close buy, your market on close sell, you get executed at a certain price. That's exactly the price the stock is added to the index. I think that what I'm saying is, so that's, you could say, well, my trading costs were zero, right? I
Mm,
put in a market on close order, I got the close price, I have zero trading costs. And I think that's one possibility. I don't want to say what index funds are doing, but that's one possibility. But, like my paper with Chris, we have a paper on IPOs. For the average IPO being added to the VTI, it increases 40% from the IPO price to when Chris buys it. There are a lot of intermediaries who buy those stocks knowing they are going to flip it 4 days later.
hmm.
We believe that should be reflected as a trading cost. That is a execution cost. You can imagine, oh, well, one, maybe no one prepares the shares and Vanguard puts in a huge order and then we walk all the way up the book on the day of. Or everyone buys the shares ahead of time, we walk up the book that way, and then it happens and there's no price impact. But I guess I'm going to push back against the idea that one, they don't trade that much, and two, I think we're mismeasuring the trading costs of index funds by just looking at the trades they make in the closing auction.
Hmm. Yeah, it's interesting. So if we did less frequent rebalancing, how significant do you think the effects would be?
Right. So I think, so John and I again find that the less frequently you rebalance in response to compositional changes, meaning adding IPOs, buying issuers and selling buybacks, returns are pretty much monotonically increasing. They start to level out around 2 or 3 years. But we actually did a crazy exercise where we said, what if you run an index fund starting in 1980
Hmm.
and you never rebalanced? So you're not going to have Apple, you're not going to have Amazon, you're not going to have any of these big names, you're not going to account for anything. That thing's cumulative return is nearly the same as the fund that rebalances much more frequently. And I think this actually goes back, you mentioned Gene Fama before. Gene Fama used to always say, no stock is so important that you need to hold it. No individual stock is so important that you should have to immediately trade to rebalance your portfolio to hold that stock. And I think that that's one of the guiding principles. And, John went to Booth and was Fama's student. So I think that was one of the guiding principles that, like Gene has been saying for a long time, no individual stock is so special that you need to hold it right away. And so returns are increasing. It does level off around, say, 1,000 days or a few years, but it does level off, but returns are increasing. And so, like we said, if you move, say, from quarterly to annual, you can improve your returns like 20 basis points. And if you go 2 years, 3 years, maybe you can go up to 80 basis points. Now, an important caveat is, when do you earn higher than the market and when do you earn lower than the market? Because we've talked to a lot of index fund managers and they say, Marco, if I underperform by 5 basis points, I'm out of a job.
Right.
Right. And so, in certain years, like 1999, where I hate this word, but like a growth episode, right? Where everyone gets really excited about tech stocks. Tech
Mm,
stocks are issuing equity, IPOing at sky high valuations, and then they continue to rise. Our sleepy rebalancing strategy is going to miss that. We're going to underperform by 20 basis points, 25 basis points in 1999. It's going to look really bad for our strategy. But then in 2000, 2001, and 2002, we're going to outperform by 40 basis points, 60 basis points, 80 basis points because we did not buy
right.
pets.com, a company that has zero, like zero revenue, infinite multiple. And so you have to be careful that, yes, we can improve average returns, but this is a strategy for a very long run investor who, on any year or 2 year basis, when there's a growth episode, whatever you want to call it, is not going to get skittish and sell out of the strategy because in the long run, we believe it does deliver higher returns.
Hmm. I didn't think about this paper when I was reading yours, and I don't think your paper mentions it, but Jeremy Siegel has a 2006 paper in the Financial Analyst Journal. Have you seen this one?
No, what's it about?
So they do what you just said. They compare the returns of the original S&P 500 firms from 1957 through 2003 to the actual index and find that the original firms outperform.
You have to send that to me. That's
I'll
that's
send it to you.
awesome. But
Yeah.
my guess, I haven't looked at it yet. Those last 6 years are really going to help his case because the stocks added from 98, 99 do really bad.
Yeah. Yeah, I think that's true. I think they have a chart in the paper showing I haven't read it in a while. I'll send it to
You
you.
got to send that to me. That's fascinating. We have to cite that paper and link to it more closely. But that's exactly consistent with kind of everything I've been telling you so far.
Yeah, super interesting. Okay, so the answer to this question might be obvious because you've kind of explained the mechanism earlier, but what is driving this excess return from delayed rebalancing?
So you're asking, why do we believe that the delayed rebalancing does better than the
Right.
instantaneous rebalancing? Well, there's actually two components of it. One, I think I explained that I'll revisit quickly, and then there's one that I haven't explained yet.
Okay.
So the one that I explained is kind of the idea of you avoid getting adversely selected by firms. And maybe that's not the exact right word, right? Because you could imagine, like, suppose for some reason, say GameStop's a good example. Some people who are not firms get really excited about GameStop and push up GameStop's price. Maybe GameStop's managers are not super privately informed, but they go, wow, our stock price went up a lot. Maybe now is a good time for us to issue equity. And then what do index funds do? They're going to buy GameStop. And so, and the same thing, and I hate to pick this as an example because again, you can miss Apple and our strategy still works. It's not just all Apple, but like Apple has done pretty well. They've been buying back shares from, whenever Einhorn started that campaign for iPrefs. They didn't do that, but they ended up doing a lot of buybacks and they've done really well. And you're again on the reducing your holdings of Apple every quarter. And so we believe by reducing your exposure, and also, like we said, you're buying unprofitable firms. You're also taking factor risk, which also has negative returns. You're buying growthy firms. You're buying unprofitable firms. You're buying stocks that have went up a lot recently. You kind of avoid these negative factor premium, if you want to call it that. And in addition, you kind of avoid this mania's adverse selection kind of problem. The second thing that we believe is important about rebalancing less frequently, and this is not in the version of the paper we have right now, is actually about how we believe trading costs work. A lot of trading cost models, like ITG has a trading cost model like this. Eric Stafford, my colleague, has a paper called The Price of Immediacy. And in all these kind of models, trading costs have some kind of curvature. Like there's some kind of like square root function usually as a percentage of ADV. Now, what does that mean? Well, when you trade a little bit, you're walking up that square root function very fast. When you trade a lot, you start hitting that point where the curvature, like you're on a flatter point, the slope is relatively shallower. And so if you're an index fund and you have to trade all the time, especially when, to make room for an IPO, you have to trade 3,500 stocks, you're going to be on that really steep point of the trading cost curve more frequently. By waiting and by putting in your trades kind of at scale, you can take advantage of some of these benefits of being further up and on a flatter section of the marginal cost curve of trading and reduce your trading costs as we have measured them, which hopefully to some degree account a little bit for the front running and some of the other elements we've been talking about.
Yeah, super interesting to think about. So, okay, you mentioned the tech run up being like a pretty rough time for this lazy rebalancing because you're missing out on the growth stuff. The other thing I was just thinking about is this makes me think of Zahi Ben David's paper on thematic ETFs. Like you're basically buying like something that looks like the thematic ETF portfolio.
Exactly. And so just to catch people who haven't seen Zahi's paper, it's a super cool paper. As far as I remember it, the idea is people make indices on all types of things. And sometimes indices don't even have an ETF yet. They're just like an index of, Ben and Dan's favorite value stocks. When those indices have gone up a lot, people are like, oh, wow, now is the time I better launch an ETF on that index. They do exactly that. And of course, they're buying high, right? And then the performance reverts. And then these newly launched ETFs are disastrous. And it's exactly has that flavor. But the important thing here, and going back to Sharpe's arithmetic, because I think that's a good kind of null hypothesis for the whole thing, it comes from the investment universe changing. When companies issue equity, buy back equity, or companies get IPO'd, it changes the universe of stocks. And that's one place that the margin of Sharpe's arithmetic can break down. Zahi's paper is about something a little bit different that's within the existing set of universes. This is a new ETF. On ours point is just a little bit different on like the, change in the composition of the market.
Yeah, okay, that makes sense. Okay, so what I was going to ask, I got distracted by the Zahi Ben David thought. How much tracking error are we introducing by delaying rebalancing?
Right. So tracking error is gonna have, again, it's like funny. I wish I had my slides in front of me. Maybe next time I'm on, like I'll have like a little slides. As you're gonna delay rebalancing, you're gonna have more and more tracking error. But because no stock is super special, like with everything else we talked about, it is gonna level out at some point. There's some point where the tracking error is not gonna increase that much more. And so, if you rebalance, say, once a year, you might have 80 to 100 basis points of tracking error at a daily level annualized relative to our ideal version of the market. Now, to push, I think that a lot of people are going to say, wow, Marco, my tracking error budget is 5 basis points a year. This is something I can't stomach. We can't do that. But I think John and I believe, what if we just defined a new index? What if we defined Marco and John's sleepy rebalancing index? You could run an index fund with zero tracking error with respect to the index as we have defined it. And so, I think it's a good question. Like, yes, we're going to incur more and more market tracking error by delaying more slowly. But if that's the goal of what the fund is doing, we think it's okay. And then I want to ask you guys here, because this is something that John and I were really wondering. Like, why do you think the index fund world has become so obsessed with tracking error? Like, this is the way we compensate managers. This is how people get and lose their jobs. I've talked to a lot of people who say, like, all I care about is minimizing tracking error. Like, is there a huge agency problem? Meaning, like, are people really worried that, like, people are going to run the index fund badly and we need to really tie their hands by, just giving them a tracking error budget? Like, why is this the equilibrium we're in?
Dan, do you want to say anything? I've got comments.
Yeah, that's a really interesting question. I would say that certainly most individual investors are not going to be sensitive to it, but as advisors who um, work with clients and expound on the virtues of index funds, we do want to hold the funds accountable and look for those low tracking errors. I can think of a specific example that happened a few years ago with an iShares fund that was supposed to be a total market US equity fund. They tried to get a little creative in I honestly don't know what they were thinking, but they could have simply bought all the stocks in the index like everybody else does. Whatever they did caused a very significant tracking. It was something like 50, 60 basis points, or it might have even been more than that. And yeah, as advisors who were using that fund, we actually went to the fund provider and said, "What are you guys doing? You have a responsibility to deliver the index return. And it's not your job to get creative and try to improve on it. And by doing so, have it backfire." So I do think there is some accountability and there is some expectation. That's why I find it so interesting that you're saying it becomes self-referential at some point. It's like, well, we build the index and then we implement the index and we pat ourselves on the back for tracking the index perfectly. But you've pointed out the very important distinction between tracking the index and tracking the market that the index is supposed to be a proxy for. And those are not the same thing.
But it,
Right.
it matters. Like in the example Dan just talked about, we do annual fund due diligence for all the ETFs and mutual funds that we use in our business. And we put a big warning on that fund that year. Like we are watching this very carefully and we may not continue to use it if they don't solve these problems. Like it's a real issue. And I would also think about some of the investment committee work that I do. Like indexes are just, they're the reference point. And so even if an investment committee decided we're going to do this lazy rebalancing thing, if you have a year of negative tracking error to the index, which you're still going to benchmark to, even if that's not what your fund is benchmarked to, it's a problem. Like it's a real problem. Should we keep doing this? I don't know. It underperformed this year.
Right. So just to say one more thing on that, or I guess two more things on that is, I think what you're saying is if I'm going to use this as a building block in my broader strategy, I want to know that this is the building block I think I'm getting. And like, especially if you're hedging some risk, right? You're like, I'm going to buy Facebook and short the tech ETF. I want to isolate my Facebook risk. And if all of a sudden my hedge isn't hedging what I thought it was, I would be really mad. I would tell those people, okay, this is not right. But then I guess this gets now to the second question, which I wanted to talk to you about is like this idea of this spectrum of whether this is active or passive. And I'm curious, like when I say the word passive or someone says the word index, how do you think about that with your business? And then I'll tell you kind of what I think about that.
It's something that we've struggled with the language on for a long time. Dan and I have slightly different approaches to portfolio management. Dan is generally using total market index funds. I'm generally using funds from dimensional fund advisors, which tilt toward small cap and value stocks a little bit, but are pretty close to an index fund. So we just kind of say it's a spectrum and that dimensional is closer to index funds, but it's not an index fund. But yeah, it's not an easy thing to communicate.
Right. Sorry, Dan, do you want to add to that?
Yeah, I was just going to say that we were chatting, Ben and I, a little bit before about this idea that I think somewhere along the line, those of us who advocate index funds can sometimes slip into this notion that indexing is an ideology, right? In other words, cap-weighted indexes are perfect. They are the natural order. We must follow them exactly, and any deviation from that is not passive. It's a silly idea, and that's why I like the ideas in your paper so much. It's this idea is, look, the index is supposed to replicate, it's supposed to be a reflection of the market, but it's always going to be imperfect. So if we add a few extra rules that actually counterintuitively reflect better what the market is rather than just simply reflect this man-made index, then there's a lot of potential for improvement here. I think the challenge, and this goes back to the question about tracking error, is how do you benchmark it, right? In other words, so if you're, if my S&P 500 index fund, I can compare it to the S&P 500 index, but your sort of sleepily rebalanced fund, what do we benchmark it against? And if we can't benchmark it, how can we be accountable?
Right. So I have three replies on that. Hopefully I remember all three of them by the time I'm done talking about it. So first of all, I like to give as a fun example is like, you're right, there's a spectrum of like fully passive, meaning we hold the market every second there is, and fully active, like Bill Ackman holds 6 stocks, and he's really convinced about those 6 stocks. Now, now Vanguard Total Market is really close to that ideal of the totally passive fund, right? Now, we're saying we should rebalance less. Russell has until next year, I think, annual rebalancing. Does anyone go, oh my God, Russell is so active. They rebalance once a year. This is a huge deviation from the market. Of course, actually, among all the major index families, this is not a critique of Russell because Russell actually also does better in line with our findings. The Russell 3000 does better because it waits, but like Russell deviates from the market by delaying rebalancing. Also, they trade all at once, so they walk up the trading cost curve in a smarter way. No one said, no, I've never heard anyone in the world ever say that Russell's really active for making that decision. And they're like, your thing is really active. You're delaying rebalancing. I'm like, well, other people are doing it and no one says it. So that the first thing I want to say is that we hold all the same stocks as VTI. We just rebalance them with a little bit of a delay, excepting for IPOs. That's the first thing. The second thing is, there's been a huge growth, and we haven't talked about this yet. And this is related to Zahi's paper of these thematic ETFs. Like my favorite example is COWS, COWZ. It's the 100 most profitable stocks in the Russell 1000, and it's like weighted by cash flow yield. So not only is it not the whole market, it's not value weighted. They ended up putting a weight cap on it that I think you can't have more than a weight of 5% in the index because there were certain stocks that had a huge free cash flow yield. Dividend ETFs have this same problem where you weight by dividend yield. And so I think that in recent years, there's been an explosion of index products, meaning they follow a set of publicly available rules that do not look at all like the market. And I guess what John and I are saying is we have a set of publicly available rules. Like we could say you rebalance after a buyback by weight up 252 trading days. Like it is a set of public rules, but it looks kind of like the market. So that's kind of, I want to push back. And, now I've gotten so into this, I forgot my third point. I'm sure it'll come back. It'll come back later when you guys ask me a few more questions.
The cows point makes me think of Adriana Robertson's paper on passive in name only. Are you familiar with that one?
I don't know it, but I think from the title, I understand the flavor.
Yeah. She talks about that. She talks about, I can't remember what they're called, but indexes that are created by the fund managers themselves.
Yep.
And so it's really just an actively managed fund, but they call it an index fund because they're tracking an index, even though they've made the index.
Yeah. And, if you think about like DFA or whatever, right? Like they also, they have like they try to trade smarter, right? They try to, do smart things when small stocks, they can get them at a discount. Like, where do we draw the line between a public rule, like taking a little bit of tracking error to like trade a little smarter? Like it's really hard.
Yep. How do you think investors should decide? So like I mentioned, the investment committee example, that's a hard thing because you've got a bunch of people with varying levels of knowledge and you've got to benchmark against something. To Dan's point about accountability, how do you think investors should decide on their optimal excess return from lazy rebalancing to tracking error trade-off?
So that's a great question. And I think there's some introspection, which is how long am I going to have this investment? I actually think that for retail investors who, when they underperform their buddies by 20% or 30% and are going to go, wow, what's going on? This is a very different value proposition than I'm running a pension fund that needs to provide cash flows 50 years in the future. And one bad year this year for 3 amazing years next year is a trade-off I'm willing to make. So this first step is like, how long are you willing to stay in this? Now, John and I's strategy outperforms almost every year for the past 40 years, except for, the 99, 98. And I think after COVID, a bunch of companies issued equity. And then when the rebound happened, it underperformed a little bit. Of course, that equity ended up not being amazing, but there's a few years. So can you stomach 1 or 2 years of underperformance? And then we kind of have like that somewhere around 2 years, if you use our concept of market tracking error and market information ratio, our market information ratio is, this is not in the paper yet, it's going to go up very soon, I hope. Around 2 years is where you maximize the market information ratio. Now, of course, the last thing we haven't talked about is how big is this strategy? How many people are doing this strategy, right? So I think that one good thing about our strategy is it's kind of immune in many ways to gaming by firms by introducing a fixed delay. So if you rebalance quarterly, if a company issues equity on the second to last day of the quarter, they might buy it 2 days later. Even if you rebalance once every 5 years, if you have a fixed period of rebalancing, firms could just wait and then issue right before when they know they're going to have an elastic buyer. Our methodology imposes a fixed delay on all compositional changes. So that type of gaming, I think we're pretty immune from. The type of gaming we're less immune from is the front running. And so, even if you're going to wait 2 years to rebalance, people who are sophisticated and can predict that, remember, this is all public rules, they could still front run you, and that would show up as trading costs. And the bigger you got, the bigger your trading costs would be, and that might not even be linear. And so I think this is something that I don't have a great answer for yet. But I do think that right now we kind of have a partial equilibrium view of you're one person running this strategy for, something that is not systematically important in the passive industry ecosystem. As that changes, the rules we need might change. And so I can't speak to that yet, but somewhere around with our partial equilibrium calculations, 2 years is close to optimal.
This probably isn't proper equilibrium thinking, but no, not everyone's going to do this because of the tracking error.
Totally.
I don't know how you do an equilibrium model of that, but it's just not going to happen. People are still going to prefer, a lot of people are still going to prefer index funds because they can't stomach any tracking error.
They can't stomach any tracking error relative to the really famous benchmarks like the S&P 500 or the Vanguard Total Market. Yeah, exactly. I totally agree. And so I think that, it is a little bit, I'm just trying to hedge a little bit and say there are some products that have become very huge. VTI now is buying 7% of the float of every IPO. That is a massive demand shock that is coming. You've had Val on here and Ralph on here and many people, we have a massive inelastic demand shock. And so I'm just saying that John and I want to be careful that if people move towards not even our model, but any model of rebalancing differently, whether it's sleepy rebalancing or instantaneously rebalancing or here's one other thing, right? A weird feature, and I wanted to stick this in here because I think this is so cool. I forget what movie it's from. It's you don't skate where the puck is, you skate where the puck is going, right? This is an old adage in hockey. So when an index fund gets inflows, they scale everything up. So think about VTI, they scale everything up. And then at the end of the quarter, they end up selling Apple, which bought back. So now they're trading Apple twice. They're scaling up Apple when they get the inflows, and then they're scaling it down at the end of the quarter for rebalancing. Why not, if you're getting inflows, just put those into the things you're going to have to buy in the next regular rebalance, as opposed to putting them in things you literally already know you are going to have to sell in the next rebalance. Trading twice doesn't make sense. We could really, if we want to talk about equilibrium consequences, we could really go very far on the scope for enhanced indexing in this sense.
Yeah. I've just got one more question, and I think Dan has one last one too. What effect do you think the increasing share of index fund ownership of stocks has on the costs of the implicit costs that we're talking about of indexing as it's currently implemented?
Right. So if you take this is actually a perfect segue from our last discussion, which is, if you think indexing is getting bigger and bigger and those inelastic demand shocks, which, given the way many index funds are run now, happen all at once on one day and are predictable in many senses, you can imagine that this could increase the front running. But there is one kind of interesting data point that I want to push back on here. So many of you might have seen that there was a Bloomberg article a few months ago saying Millennium lost $900 million in their contra index liquidity group. Now, this goes back to Jeremy Stein has a paper from the late 80s, I think, about the idea of an unanchored strategy. And I think this is one reason answering your question is so hard. What do I mean by unanchored strategy? Suppose you, Dan, and I all know that some fund is going to buy 1 million shares from Tesla a month from now. Now, all of us start accumulating shares ahead of time with the idea of selling it to the fund. I tell you guys, you shouldn't accumulate any shares. I've already got all the shares. We're going to tank the price. We can't commit to this, right? This is like Cournot competition, or like maybe even you think Bertrand competition in the extreme, right? Now, if everyone bought too many shares because we cannot coordinate, we cannot commit. We all buy too many shares, we all sell them in the closing auction, the price goes way down, and then all of our trades get blown out of the water. So in this sense, it is an unanchored strategy because none of us can commit ahead of time to limiting the quantity that we front run indices. There's a great anecdote in Ugly Americans, that a book about exactly this. And so I think that even though these groups have had many good years, there was an article in Bloomberg like 2 years ago saying, groups at major banks are making hundreds of millions printing money. And then you have a year like this year where they're losing hundreds of millions. And so I think that this coordination problem and this unanchored strategy problem makes this problem really almost impossible to predict. I don't know. What do you think?
I think that makes sense, what you said.
Mark, I'm just wondering if there's any kind of genuinely practical application here in at least in the medium term. One of the trends we've seen in the index fund world is more and more funds are looking to alternative index providers, mainly to avoid the high licensing fees of the big guys like S&P and MSCI and so on. And so these sort of secondary index providers are looking to provide an alternative that has some advantages and not just, hey, I'm going to pick 500 large cap US companies and make this kind of faux S&P 500. I'm wondering if you have heard of any index providers who are kind of looking at this kind of research and saying, hey, we're going to start with these traditional cap weighted indexes, but we're going to add this sleepy rebalancing strategy or some form of it. And we're actually going to suggest to you that this can improve performance benchmarked against the traditional indexes.
So it's interesting, without sharing too much information, because we've talked to a lot of people about this. When we got covered in Matt Levine's article, a lot of people reached out to us to do, I talked about this last time in the podcast, right? Whenever you have a good idea, everyone says, oh, I knew it already. I had heard this is my idea. So what's interesting is some very large institutional managers. These are not fund providers. These are people who are like, think sovereign wealth funds, think pension funds. They reached out to us, the people from their enhanced indexing groups, and said, yeah, we knew this. We never do this. They actually, they try to participate a little bit in the front running, right? They buy a little bit ahead of the ad. They hold on to the drops for a little bit and get some of the bounce back. Like, I think that enhanced indexing groups at very large institutional managers who have the trading expertise and who have a long-term focus and can stomach the tracking error, they are already doing this, even if it's not a retail-oriented product yet. But I do think that you're making a good point that, like, I think CRISP is a great example of this, right? That, like, having a 5-day rebalance, letting the rebalance be spread out a little bit, having a little bit of uncertainty so you can't be perfectly front run. I do think that, in many ways, these index providers that we follow, like Dow Jones or S&P or Russell, these are really old indices. These are things that date back, 50 plus years. And so a lot of modern indexing may be a historical accident, right? That these index providers who were started a long time ago with a price-weighted index, because that's easy to compute, back in the 1920s, like that somehow has carried over 100 years. And we think that if a lot of indexing is historical accidents, why don't we just start from first principles? We want to follow the advice of the CAPM. We want to track the market, but we don't want to expose ourselves to well-known risk factors. So why don't we just design a set of rules that does that?
It's a great question. I mean, I don't think there's any question that Dow Jones is a historical relic. If somebody were to create such a benchmark today, it would be laughable. And the only reason it still exists and is so popular is because, well, it doesn't help that Dow Jones is a large media company as well. But yeah, I mean, I think you're right. You take, what are all of the ideas? What are the core principles that make indexing so powerful?
Yes.
Just stick to those and recognize that there are some other factors in constructing and managing an index fund that don't really add any value and probably subtract it. So if we can reduce those frictions and just stick to the big ideas, the question is, how successful can it be implemented? And I guess that remains to be seen.
Right. I think I couldn't say it better than you. That's exactly right. That we should stick to the principles, and we can now, again, this is not a criticism of Russell and S&P, but like these are indices that have been around for 30 years more. We can revisit these ideas and rebuild them given what we know.
I think it's important always to remember that those original indexes were not designed to be investment strategies. They were designed to be benchmarks for active investment strategies, right?
Right.
The
That's
S&P
another good point.
500 predates S&P 500 index funds by at least 20 years. Right.
Right. That's a great point that we haven't connected to that yet, but that's a great point that these were originally designed to evaluate active managers.
Right.
Hmm.
So,
Not to pile on to the, other people thought of this before you, but
But you thought of it first.
well, I didn't. But DFA, like you said earlier, they do think about a lot of this stuff, but most of their strategies are factor strategies that are tilted towards certain types of stocks. But they do have one ETF that they converted from a mutual fund. I can't remember when. It's fairly new, but it's a total market ETF. It doesn't have any factor tilts. It just tries to replicate or capture the returns of the market, but it follows DFA's trading strategies, which includes delaying buying IPOs by like a year. I think it's a year, and other stuff like that. And they don't follow a fixed rebalancing strategy. It's all flexible trading to try and minimize transaction costs. And when I read your paper, I went and looked at how that fund has performed relative to VTI. And when I looked at it, I don't know if it's changed since then, but when I looked at it, it had outperformed by about 50 basis points, which is kind of like right in line with what your model suggests.
I did not know that. I got to look this up after. We got to talk about this afterward. That's like an awesome, everyone says, "Oh, what if you actually," this is kind of like Dan's question. What if you actually run this strategy? What does it look like? How does it do? That's kind of a nice first step towards, okay, someone tried to run this and they can do better to the tune of our exact estimates.
Yeah. Yeah, I thought that was pretty interesting. Cool. All right. This has been a great conversation, Marco. I think this paper is super interesting. Like I said, as soon as I saw it, I knew we had to have you back on to talk about it. But I think you're getting at some stuff that, like Dan said earlier, indexing has become in a lot of ways ideological. Like there will be people in the Bogleheads community who are going to be absolutely furious about this episode. But I think it's really important, and I think what you've done here is really sensible.
Well, yeah, well, thank you. And I hope, they can, reach out to me and we can have a discussion. I hope no one's too mad about this, but, thank you so much. This is awesome. I actually learned a lot from you guys, a lot of ideas that John and I hadn't thought of and that we're going to have to incorporate into the next draft because this is super cool.